Have you noticed something unusual happening in the gold market? Every time investors expect gold to break into a new rally, sellers suddenly appear. Yet every time prices fall toward an important support level, buyers quickly step back in. This tug of war is telling us something important. The battle is no longer just about inflation or interest rates. It is about the future direction of the global economy, the US dollar, central bank policy, and rising geopolitical uncertainty. The biggest question today is simple. Is gold preparing for another major breakout, or is this simply a temporary pause before another correction? By the end of this analysis, you'll understand why professional investors are paying closer attention to the Federal Reserve, the Middle East, and the US dollar than to the daily movement in gold prices itself. Let's begin with the latest verified market picture. Gold entered the final trading session of the week under moderate selling pressure after failing to hold above an important resistance zone. According to the source market report, spot gold pulled back during the Asian session while the US dollar recovered from the sharp losses recorded a day earlier. Whenever the dollar strengthens, gold often faces short-term pressure because the precious metal is priced globally in US dollars. A stronger dollar makes gold more expensive for international buyers, reducing immediate demand from overseas markets. However, the decline in gold should not automatically be interpreted as a sign that investors are abandoning the metal. When we step back and examine the broader trend, we see a different picture emerging. Despite the latest pullback, gold remained on track for a monthly gain. This tells us that buyers are still entering the market during periods of weakness rather than chasing prices only after rallies. In professional trading, this behavior is commonly known as buying the dip. Instead of reacting emotionally to temporary declines, long-term investors use corrections to build positions when they believe the fundamental outlook remains supportive. The next question is obvious. Why are investors still interested in buying gold even after the Federal Reserve decided to leave interest rates unchanged? The answer lies in the balance between monetary policy and economic uncertainty. During its latest policy meeting, the Federal Reserve kept interest rates steady while offering very little guidance about the timing of its next move. Instead of providing markets with a clear roadmap, policymakers emphasized that future decisions would remain dependent on incoming economic data. In other words, inflation, employment, and economic growth will determine whether rates remain unchanged, move higher, or eventually begin falling. For financial markets, uncertainty often matters more than the actual decision. When investors know exactly what the Federal Reserve intends to do, markets usually adjust quickly. But when policymakers leave multiple options open, volatility often increases because traders continuously reprice future expectations after every major economic release. Recent economic data presents a mixed picture. The latest figures from the U.S. Bureau of Economic Analysis showed that the economy continued expanding during the second quarter, although growth slowed compared with the previous quarter. At the same time, inflation continued easing from the exceptionally high levels experienced after the pandemic. The Core Personal Consumption Expenditures Index, the Federal Reserve's preferred inflation measure, also showed further moderation, suggesting that price pressures are gradually cooling. Normally, slower inflation would be positive for gold because it increases expectations that the Federal Reserve may eventually reduce interest rates, but markets rarely focus on only one variable. At the same time, inflation has moderated, geopolitical tensions have intensified. Developments in the Middle East continue creating uncertainty around global energy supplies and international shipping routes. Investors understand that any disruption affecting energy markets can quickly feed into inflation through higher transportation and production costs. That possibility makes it more difficult for the Federal Reserve to declare victory over inflation. This is why gold remains trapped between two opposing forces. On one side, easing inflation supports expectations for a less aggressive Federal Reserve, which is generally positive for precious metals. On the other side, a stronger US dollar, elevated treasury yields, and expectations that interest rates could remain higher for longer continue limiting gold's upside. In simple terms, neither the bulls nor the bears have gained complete control. Instead, the market has entered a waiting phase, where every major economic report has the potential to shift investor sentiment. For gold and silver investors, this is one of the most important environments to understand. Markets are no longer reacting only to today's data. They are trying to anticipate tomorrow's policy decisions. Every inflation report, employment release, consumer spending figure, and Federal Reserve statement now carries greater significance because each one could influence expectations for the next phase of monetary policy. And while these these economic forces continue pulling gold in opposite directions, another factor is quietly becoming even more important. It is not inflation, it is not interest rates, it is geopolitical risk. Because if tensions in the Middle East continue escalating and energy markets become more unstable, the safe haven demand for gold could become far more powerful than any short-term movement in the US dollar. As we examine how the Middle East conflict, oil prices, and global shipping routes could determine the next major move in gold and silver. Verified references used: U.S. Bureau of Economic Analysis, GDP and PCE data, Federal Reserve Policy Statement, and the Supplied Market Report. Any forward-looking views are presented as analysis rather than certainty. DYOR, do your own research. At this point, the gold market is no longer waiting for another headline. It is waiting for confirmation. Confirmation that inflation is truly moving lower. Confirmation that the Federal Reserve is finally approaching the end of its tightening cycle. And confirmation that geopolitical risks will either ease or escalate. Until one of those questions is answered, gold is likely to remain trapped between powerful bullish and bearish forces. This is exactly why professional investors spend less time watching the daily price of gold and far more time studying the bond market. Many retail investors focus only on the US dollar, but institutional traders know that US Treasury yields often provide an even clearer picture of where gold could move next. Treasury yields reflect what investors expect for inflation, economic growth, and future Federal Reserve policy. When yields rise because markets expect tighter monetary policy, gold usually struggles, since investors can earn higher returns from interest-bearing assets. But when yields begin falling because markets anticipate slower growth or future rate cuts, gold often becomes more attractive. This relationship has repeated itself through multiple economic cycles. Today's market is particularly sensitive because investors are trying to answer one critical question: has the Federal Reserve already done enough to control inflation, or will it need to keep policy restrictive for longer? The latest economic releases provide mixed signals. The economic growth has moderated, suggesting that higher borrowing costs are beginning to slow parts of the economy. Inflation has also eased compared with previous highs, indicating that the Fed's tightening campaign has made progress. However, inflation remains above the central bank's long-term objective, and policymakers have repeatedly stated that they need greater confidence before changing policy direction. That uncertainty explains why markets continue reacting strongly to every major economic report. A stronger than expected employment report could increase expectations that interest rates will remain elevated, strengthening the US dollar and creating short-term pressure on gold. On the other hand, weaker economic data combined with further moderation in inflation could strengthen expectations that monetary policy may become less restrictive in the future. In that scenario, Treasury yields could soften, the dollar could lose momentum, and precious metals would likely receive additional support. This is why macro investing is about probabilities rather than predictions. No responsible analyst can say with certainty what the Federal Reserve will do at its next meeting. Instead, investors monitor incoming data and adjust expectations as new information becomes available. Now let's shift from macroeconomics to market structure. One of the most noticeable features of recent trading has been gold's inability to establish a sustained move above its recent resistance zone. Every attempt to extend higher has attracted profit-taking from short-term traders. At the same time, each meaningful decline has been met by renewed buying from investors who continue viewing precious metals as long-term portfolio protection. This tells us something important. The market is not experiencing panic selling. Instead, it is going through a period of consolidation where buyers and sellers are gradually repositioning while waiting for the next major catalyst. From a technical perspective, this type of price action often represents an equilibrium phase. During these periods, volatility gradually compresses as both bullish and bearish traders reduce conviction. Eventually, a new economic or geopolitical event provides enough momentum for price to break decisively in one direction. Professional traders rarely try to predict that breakout before confirmation. Instead, they identify important support and resistance areas, monitor trading volume, and wait for the market itself to reveal which side has gained control. This disciplined approach reduces emotional decision-making and improves risk management, two qualities that separate long-term investors from short-term speculators. Silver is following a similar pattern, although with noticeably higher volatility. Unlike gold, silver's industrial demand creates an additional layer of complexity. Demand from renewable energy projects, advanced electronics, electric vehicles, and AI-related infrastructure continues providing long-term structural support. However, because silver is more economically sensitive than gold, expectations regarding manufacturing growth can produce larger price swings. This means silver may outperform gold during periods of improving economic optimism, but can also underperform when recession fears begin dominating investor sentiment. Another trend worth watching is central bank behavior. Although central banks primarily accumulate gold rather than silver, continued official sector demand has become an important long-term pillar supporting the gold market. Reserve diversification, geopolitical uncertainty, and efforts to reduce dependence on foreign currencies have encouraged many monetary authorities to maintain or gradually increase their gold holdings over recent years. This does not guarantee continuously rising prices. However, it does create an underlying source of demand that was less significant during previous market cycles. For long-term investors, this distinction matters. Short-term price movements are driven by news, speculation, currency fluctuations, and changing expectations regarding interest rates. Long-term trends are driven by structural factors such as monetary policy, fiscal sustainability, global reserve management, industrial demand, and investor confidence. At the moment, these long-term forces continue providing a constructive backdrop for precious metals, even though short-term volatility remains elevated. So where does that leave us today? The evidence suggests that gold is neither entering a major bull run nor beginning a prolonged bear market, at least not yet. Instead, the market appears to be building energy for its next significant move. The catalyst could come from a Federal Reserve decision, an unexpected inflation surprise, a sharp change in Treasury yields, or a geopolitical event capable of shifting global risk sentiment. Until then, patience may prove more valuable than prediction, because in financial markets, the investors who wait for confirmation often outperform those who chase every headline. And that brings us to the final stage of our analysis. We'll move beyond the charts and examine the bigger picture, what all of these macroeconomic developments mean for the future of gold, silver, the US dollar, and the global economy, and whether the next major move in precious metals is likely to surprise the majority of investors. As we step back and connect all the pieces together, a much clearer picture begins to emerge. Gold is not simply reacting to one Federal Reserve meeting, one inflation report, or one geopolitical headline. Instead, it is responding to a combination of powerful macroeconomic forces that are pulling the market in opposite directions. That is why price action has remained volatile, but largely range-bound. Until one of these forces clearly dominates the others, investors should expect continued uncertainty rather than a sustained trend. The first force is the US economy itself. Although economic growth has moderated, the United States has avoided the sharp contraction many analysts feared earlier in the year. Consumer spending continues to support overall activity, businesses are still investing, and the labor market remains relatively resilient. These factors reduce the urgency for the Federal Reserve to aggressively cut interest rates. For gold, this creates a short-term challenge. A resilient economy generally supports the US dollar because investors continue allocating capital toward American financial markets. Stronger economic performance also keeps Treasury yields elevated, increasing the opportunity cost of holding non-yielding assets such as gold. However, the second force tells a different story. While the economy has remained resilient, America's fiscal position continues to deteriorate. Government debt continues expanding, and annual interest payments on that debt are becoming one of the fastest growing components of federal spending. This issue rarely dominates daily headlines, yet it is one of the structural reasons many institutional investors continue holding gold as a long-term hedge. History has shown that excessive government borrowing does not immediately trigger financial instability. But over time, rising debt increases refinancing needs, places pressure on bond markets, and can gradually reduce investor confidence if fiscal imbalances continue widening. This is one reason why central banks around the world have steadily increased their gold reserves over recent years. Gold remains one of the few reserve assets that carries no counterparty risk. Unlike government bonds, it is not dependent on a government's ability to repay debt. Unlike paper currencies, it cannot be created through monetary policy. That characteristic becomes increasingly valuable during periods of elevated fiscal uncertainty. Now let's consider the third force influencing precious metals, global geopolitics. The Middle East remains one of the world's most strategically important energy regions. Any disruption affecting shipping routes or oil exports has the potential to influence global inflation through higher transportation and energy costs. Markets understand that energy inflation behaves differently from demand-driven inflation. When oil prices rise because of supply disruptions, central banks face a difficult dilemma. Raising interest rates does not increase oil production or reopen shipping lanes, yet allowing higher energy prices to spread throughout the economy risks keeping inflation elevated for longer. This explains why investors continue treating geopolitical developments as an important variable for gold. Even if military tensions ease temporarily, uncertainty surrounding global supply chains, regional security, and energy markets is unlikely to disappear overnight. The fourth force is perhaps the most transformative of all, the artificial intelligence investment cycle. Over the last few years, AI has become one of the strongest drivers of private sector capital expenditure. Technology companies continue investing billions of dollars into advanced chips, cloud infrastructure, data centers, electricity networks, and digital communications. This investment boom has two important consequences. First, it supports economic growth by creating employment across construction, engineering, manufacturing, utilities, and technology. Second, it increases industrial demand for strategic metals, including silver. Unlike gold, silver benefits directly from technological expansion because it is used extensively in electronics, renewable energy systems, electrical components, and high-performance computing equipment. As AI infrastructure continues expanding globally, silver's industrial demand may remain structurally stronger than during previous economic cycles. This creates an interesting divergence between the two precious metals. Gold remains primarily a monetary asset. Silver increasingly behaves as both a monetary asset and an industrial commodity. That dual role explains why silver often experiences greater volatility, but can also outperform gold during periods of strong industrial investment. Now let's bring all these forces together. On one side, resilient economic growth, elevated treasury yields, and a stronger US dollar create headwinds for precious metals. On the other side, persistent geopolitical uncertainty, expanding government debt, long-term central bank diversification, and structural demand from advanced technologies continue supporting the long-term investment case for gold and silver. Neither side has fully gained control. That is exactly why recent price action has reflected consolidation rather than a decisive trend. For long-term investors, this environment requires discipline rather than emotion. The biggest mistakes are often made when investors react impulsively to individual headlines without considering the broader macroeconomic context. Professional investors instead ask different questions. Has the long-term investment thesis changed? Has monetary policy fundamentally shifted? Has inflation returned sustainably to target? Has geopolitical risk meaningfully declined? Have central banks stopped accumulating gold? Has industrial demand for silver weakened structurally? At this stage, the answer to most of those questions remains no. That does not guarantee higher prices tomorrow, but it does suggest that the long-term foundations supporting precious metals remain largely intact. The market is simply waiting for its next major catalyst. And that brings us to the final part of our analysis. We'll build our independent macro outlook for the months ahead. We'll discuss the most likely scenarios for gold, silver, the US dollar, treasury yields, and Federal Reserve policy, and explain how investors can prepare for different outcomes without relying on speculation or emotion. Finally, we'll answer the question every precious metals investor is asking. Is this consolidation the beginning of a new bull market or merely a pause before another correction? Why is gold struggling to break higher, even though the world appears more uncertain than ever? At first glance, the answer seems confusing. Inflation remains above the Federal Reserve's long-term target. Geopolitical tensions continue affecting energy markets. Government debt is expanding, and global investors remain concerned about long-term fiscal stability. Under normal circumstances, these conditions would appear highly supportive for gold, yet the market has continued moving sideways. The reason is simple. Gold is currently caught between two competing macroeconomic forces. On one side, investors continue buying gold as a hedge against geopolitical uncertainty, long-term inflation risks, and growing fiscal imbalances. On the other side, relatively high U.S. interest rates, elevated treasury yields, and periodic recoveries in the U.S. dollar continue limiting aggressive upside momentum. Neither side has gained complete control. That explains why every rally has faced profit-taking, while every meaningful decline has attracted fresh buying from long-term investors. This is not the behavior of a weak market. It is the behavior of a market waiting for confirmation. The next major move in gold will most likely depend on one question. What happens next with U.S. monetary policy? If upcoming inflation data continues showing gradual improvement and economic growth slows further, the Federal Reserve could eventually gain enough confidence to begin easing monetary policy. Lower interest rates would reduce the opportunity cost of holding gold, weaken support for the US dollar, and potentially improve investor sentiment toward precious metals. That would represent a constructive environment for both gold and silver. However, there is another scenario investors cannot ignore. If geopolitical tensions continue disrupting energy markets and oil prices move significantly higher, inflation could prove more persistent than expected. In that case, the Federal Reserve may decide to maintain restrictive monetary policy for longer. Initially, that could create short-term pressure on gold through higher treasury yields and a stronger dollar. But over time, if investors begin worrying that higher rates are slowing economic growth while government borrowing continues increasing, safe haven demand for gold could strengthen once again. This is why experienced macro investors rarely focus on one economic indicator in isolation. Instead, they watch how inflation, employment, GDP growth, energy prices, bond yields, and central bank policy interact with each other. The direction of gold will ultimately depend on which of these forces becomes dominant. Now let's talk about silver. Silver's outlook remains both exciting and challenging. Unlike gold, silver has two powerful demand drivers. The first is investment demand, where investors buy silver for many of the same reasons they buy gold: portfolio diversification, inflation protection, and financial uncertainty. The second is industrial demand. The global expansion of artificial intelligence, renewable energy, advanced electronics, electric vehicles, and high-performance computing continues creating structural demand for silver. Every new data center requires electrical systems. Every advanced semiconductor facility depends on precision manufacturing. Every solar installation increases industrial silver consumption. This long-term industrial transformation is one reason many analysts believe silver could experience stronger percentage gains than gold during the next major commodity cycle. However, investors should also remember that silver remains significantly more volatile. Its larger industrial exposure means economic slowdowns can temporarily reduce demand, creating sharper corrections than those typically experienced by gold. For that reason, portfolio diversification and disciplined risk management remain essential. Now let's consider the US dollar. The dollar's long-term direction will largely depend on three variables. The first is Federal Reserve policy. The second is relative economic performance compared with other major economies. The third is investor confidence in U.S. fiscal sustainability. As long as the United States continues delivering stronger economic performance than many developed economies, the dollar is likely to retain important structural support. But if growth slows more rapidly, while debt continues expanding and markets begin anticipating future monetary easing, some of that strength could gradually fade. This relationship matters because a weaker dollar has historically provided an additional tailwind for precious metals. So, what is my independent macro view? Based on the currently available verified economic data, I believe the global economy is entering a transition phase rather than an immediate crisis. The United States continues showing resilience through consumer spending, private investment, and relatively stable employment. Inflation has moderated significantly compared with previous highs, although it remains above central bank targets. The Federal Reserve is approaching an important policy crossroads. Meanwhile, geopolitical uncertainty, expanding government debt, and structural investment in artificial intelligence continue reshaping the long-term macroeconomic landscape. Taken together, these factors suggest that volatility is likely to remain elevated throughout the coming months. For gold investors, patience may prove more valuable than chasing short-term price swings. For silver investors, the long-term industrial story remains compelling, but higher volatility should be expected. The most successful investors are rarely those who react first. They are the ones who remain disciplined while others become emotional. Remember, markets move in cycles. Fear creates opportunity. Euphoria creates risk. And understanding the difference between temporary market noise and genuine structural change is what separates successful long-term investors from short-term speculators. If today's analysis helped you understand the bigger macro picture, make sure to subscribe to Macro Bullion. Every week, we break down the latest developments in gold, silver, the US dollar, central banks, inflation, interest rates, and the global economy using verified data, independent analysis, and clear explanations without sensational headlines or market hype. Now, I want to hear your opinion. Do you believe gold is building the foundation for its next major rally? Or do you think higher interest rates will keep precious metals under pressure for longer? Let me know your view in the comments below. And as always, remember this. This analysis is based on publicly available information and verified macroeconomic data available at the time of recording. Market conditions can change rapidly, and future outcomes are never guaranteed. This video is for educational purposes only and should not be considered financial advice. Always DYOR, do your own research before making any investment decision. Thank you for watching, and I'll see you in the next analysis on Macro Bullion.